All right. Good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We're what 28, 29 minutes after the Fed rate cut. Fed did lower rates by 0.25%, but as I mentioned this morning, what I was really interested in is kind of how political things got between Powell and President Trump. Now, we have seen President Trump respond about 4 minutes ago. He tweeted, Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision, a terrible communicator. Okay, great. That's basically what he says there, and we'll see what Powell says here. His testimony is going to start here in about 30 seconds. So I will have one eye on that as I am talking. So if I pause, my apologies there. But obviously, we see where the U.S. president stands. We'll kind of see how political Powell kind of drives some of this. And I mentioned that if there's political rift, if the Fed kind of takes some of the political bait and the rift gets stronger, I think that's a catalyst for more downside in the market. If they're able to kind of come together a little bit, I think the market would buy that up in a big way. And right now, early indications are that it is a growing rift, not a smoothing type of a situation here. So that's what we're seeing initially. You can see, the reaction that the S&P has had to the Fed rate cut. Initially down and then right back up and then, back on down and now sitting near the lows. But about a 20-point reaction range, which is not an incredible range. I mean, we're not talking about, one of the biggest ranges ever or anything like that, but it is a larger range than we have seen of late. And, we talked this morning why that would be. And, again, I don't think the reaction range is over just simply because of how the Fed staggers their announcement and the testimony. Still have a lot to go here in regards to the Fed statement. Okay, so as that goes on, let's go catch up here on the challenge. There are no new signals right here, but that said, let me show you something, and we could have some signals by the end of the day. If that is the case, I will get into them tomorrow morning. Okay, so if we have some signals here by the end of the day, I will look to get in. But here are all the stocks on the challenge watch list with downside 3-7 crossovers on them right now. Some of these are the same that were on here this morning: American Airlines, FedEx, IBM, JD, AT&T, UPS, Walgreens, but U.S. Steel popping up here. With a downside 3-7 crossover on it. Lower high, I would not be surprised to see a trigger come in here for it. We have Netflix that is new on this list. Home Depot, which is popping onto this list. We have some downside 3-7 action. The stocks that had upside 3-7 crossovers this morning were Microsoft. It is failing. GLD, it is failing. GOLD, it is failing. Right, which is not uncommon. In fact, in this market, we have seen that most crossovers, the stocks just aren't getting, follow through to them, and it's a big reason why we just haven't seen many signals at all. It has been one of the driest signal periods over the last about 2 years in terms of testing. We did have a real dry period, back in some of the 2017 time period, but it has been extremely dry, and that is just because of all the the chop back and forth that we see in so many things. And no new signals on the board, but should U.S. Steel signal, should this be a bearish signal by the close today, I will look to get into it tomorrow morning. Same with Netflix. These are the two that have the best chance of some sort of signal. Netflix has had a nice little basing out here, so I'm not sure how much downside potential we can expect, but we'll we'll see kind of how that how that plays out. So going to stay in cash right here, and not going to enter into anything. Now, the rate cut reaction, right? What has been, we looked here at the S&P, but I'm going to zoom in here or zoom out here a little bit. And I'm going to put different sectors in. I want you to kind of just take a look here. Here are the industrials. Okay, yeah. Here's the reaction right over here on the right hand side, and it looks like the S&P, right? Here are financials. Okay, outperforming a little bit. Okay, what about materials? Look like industrials. Consumer staples look like industrials. Consumer discretionary looks like industrials. Healthcare looks like industrials, right? Utilities looks like industrials, right? Everything's pretty much moved the same except for energy and transports to some degree, but really energy and financials have been the ones that have moved a little bit differently, and energy hasn't moved all that differently, right? So financials holding on up here a little bit, outperforming since the Fed. If we look at bonds are barely moved here with the Fed. I mean, bonds have barely budged. You don't see that very often when it comes to the Fed. The U.S. dollar has moved on higher a little bit, nothing to any real extraordinary degree. So when we look across the board, dollar, bonds, banks, even market itself, it's a muted reaction outside of the actual stock market world. The other kind of gold, bonds, the other big markets, they're fairly muted, at least for now. And again, any of this can change very quickly here as we have the Fed chair speaking. I'm not sure if it started here just yet. Yeah, okay, there. So it looks like we're ongoing here with that. So anyway, that's the initial reaction, very kind of plain Jane vanilla. I don't think there's a whole lot into it that you read and you go, well, you know what, the market's going down from here or the market's going up from here. I don't think we can kind of read anything of that nature. Market is retesting the lows from Monday. On Monday's gap down in the market, so we are seeing those lows get retested, and that support level, will it hold? But there is one area that we are seeing trade a little differently here today, and that is small caps, the IWM. And you can see since the Fed, the reaction's similar to the rest of the market. But small caps have been selling off all day. And small caps have really led the way here of late. And, well, here we go, if I could type that correctly. But here's the IWM. And so we've had small caps leading the way, right? They've been a big, big leader. But today they're breaking down below that 7-day moving average, right? They're popping down below that average. Okay, not a big deal. But let's take a look at times where it's been near highs and broken down below the 7 before. Right here, right? Was up near a high, broke the 7. Right here was up near a high, broke the 7. Right here was up near a high, broke the 7. Right here. Right here. Okay. Right back here. And right here. What do all these areas have in common? Right? They don't all have in common a big sell-off afterwards. In fact, some are small sell-off, bounce to new high. But what's the return on the IWM 2-3 weeks after it breaks below the 7-day moving average? Right? I mean, we just take a look right back here. Where's the market 2 weeks later? Well, 2 weeks later, the market's right here. Right here, where's the market 2 weeks later? Well, it's just slightly higher. Right here, where is it 2 weeks later? It's about the same level. Right here, where is it 2 weeks later? It's lower. From here, lower. From here, about the same level. From right here in August, lower. Right? So to expect some sort of monster rally off of this level with the breakdown in the IWM, I think is very difficult and something that has to be, taken into account for any investor kind of looking at the price action here today. And that doesn't say different stocks can't go up and things like that, but we have seen a pretty consistent tendency here that when the S&P, or excuse me, when the small cap index breaks below that 7-day moving average, the performance of the market is very sluggish afterwards. It's sluggish and down, right? And you look and you kind of say, okay, all right, is the market going to start pricing in the economy and all these other things? And yeah, we could go kind of like a dog chasing our tail with all those different arguments. In fact, if you look at the Fed statement here today, you have them talking about these quality elements in the economy that were the same elements that they used to argue rate hike, and now they're rate cutting, right? The job market and all that. So it's one where it's just kind of that dog chasing its tail element. Looks like Fed Chairman Powell says the Fed is seeing some additional signs of weakness abroad. Okay, not a big surprise there with that statement. I don't know that he'll really kind of say anything too outlandish here, but we'll see. The one thing about the rate cut that I think is significant is, yes, the small cap reaction before and after the cut, but also the fact that the Fed rate cut was not unanimous. There was one Fed governor who is vying to be the next Fed governor and who has openly said he would like to be, who supported a 0.5% cut, wanted to see a more aggressive cut, right? And then we had two other Fed governors who said that they did not want to see a cut here. And so it wasn't a unanimous decision. Is some of that going to play, on things? We basically, it looks like we have Powell kind of using the if-then statements. So basically, if the economy drops, then more rate cuts would be appropriate. Okay, great. If he's going to talk in those terms, he's not really going to give the market all that much to sink its teeth into. But in all, that's the reaction here so far with the market. And again, it's one where the reaction, we're right in the middle of it. There's not enough here that I look and I go, wow, okay, you make a big decision right here based off of everything we've seen just yet. Because things can still turn on a dime. We can see things weaken further. We can see things strengthen further. But if you want to play what has been the norm, around the Fed reactions here is that the level that the Fed in the short run, right? In the very short run, the level that the market is at before the Fed happens tends to get hit again after the big move, right? One way or the other. And the move has been down, right? We've seen the move down here. To see it snap back up to 3,000 here on S&P futures would not be a big surprise. Now, before I jumped on video, I did go take a look at what the options were trading at and if it would be worth it to play it, right? And I was tempted to go after the 300s, that expire on Friday, and play a little whipsaw back. At the time, just before I got on video, they were trading up around $1.05. They're now trading at 81 cents, and the market's actually a little bit higher than it was, right? There's a lot of implied there was a lot of implied volatility, but some of that's starting to come out here of these options, and you can see what's happened to these options. Even though the market's not at the low, the options are at the low, right? And so playing that snapback or playing for a snapback and getting a good price on really short-term options are two very different things, and something that has to be looked at if you're looking to play it from an option standpoint. So, when I looked at the option values, I just, it doesn't work. It doesn't pay. It doesn't, if I'm right, am I going to get paid all that much? I'm not. and if I'm wrong, I'm done. So the trade's done. So it just didn't make a whole lot of sense for me yet from a risk reward standpoint. If we see another strong move in the market, to the downside, I may take the risk and just kind of put a little bit out there for a snapback to pre Fed levels. But you look at where this option was ahead of the Fed. $1.60. It's been cut in half very quickly. We're not talking about a that big a move here with the Fed so far. Okay. As I'm talking, we are seeing gold continue to sell off. In fact, let me pull it up here. You can see gold really just continuing to slide here on Powell's comments. The U.S. dollar is continuing to push on higher, so we are seeing that element come in. The banks are very stable. We're seeing J.P. Morgan still trading higher, Bank of America still trading higher, so banks relatively stable here. And I think the biggest tell of what the market thinks of what the Fed's doing or saying is the TLT. And we see the TLT continuing to drop, and that is telling us what? The Fed is not, or the market's not convinced the Fed's going to cut rates again here this year. Yes, I know they made the comment that many of them expect one more rate cut this year, but I'm not sure that the market is fully buying it just yet. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.